Michael Burry just bought more of this stock and it's now his biggest holding. Stellantis, ticker symbol STLA, is a giant automaker that was formed from the merger between Fiat Chrysler and PSA Group, and it owns 14 brands including Jeep, Peugeot, Citroën, Ram and Maserati. Based on the latest share price, Stellantis now has a market cap of 59 billion euros. But the company also has 49 billion euros of cash on the balance sheet, account for debt and investments, and the enterprise value is around 29 billion. Meanwhile, the company has reported 190 billion euros of revenue over the last 12 months, 20 billion of net income and 14 billion of free cash flow, with gross margins of 20%. That makes the company one of the cheapest stocks on the market, trading at only 3 times earnings and 2 times free cash flow, and the stock pays a dividend of over 7%. Looking at these numbers, the obvious question is, where's the catch? The answer is that Stellantis is badly behind in the race for electrification. As the world transitions to electric vehicles, Stellantis sits outside of the top 5 in EV sales, and its market share in Europe has dropped from over 20% to just 18% in the space of a year. Playing from behind, Stellantis has committed 50 billion euros of investment into electrification, and that is going to affect its earnings for the foreseeable future. Meanwhile, the level of competition in the electric vehicle market continues to ramp. Tesla leads the way in terms of technology and production, while an influx of Chinese vehicles is causing a price war across the board. China's dominance in batteries gives its automakers a substantial advantage. However, Stellantis has enough cash to cover its 50 billion investment, and CEO Carlos Tavares has a rich pedigree, previously turning around the fortunes of the Peugeot Group. Recently, Stellantis partnered with Chinese firm CATL for cheaper batteries and invested in Chinese carmaker Leap Motor. The company now hopes to have 47 electric vehicles on the road by the end of next year. But not everything is rosy in the world of electric vehicles. Consumers are worried about charging, and sales of electric vehicles have fallen significantly from their peak. In Europe, a ban on internal combustion engines was amended to make an exception for eco-fuels. This could slow down the transition and actually be beneficial for Stellantis. Management thinks Stellantis can produce over 20 billion of free cash flow by 2030. If you assume it hits that target and the stock trades at just 4 times that number, the company would be worth 80 billion, and that works out to an investment return of over 15% per year. Overall, the auto market is notoriously difficult, and it's not uncommon to see low profit margins and low earnings multiples. But at only 2 times free cash flow, Stellantis stock is already pricing in the worst. For these reasons, I give the stock a bullish rating, and I might buy the stock in the near future. But these are my personal opinions, not financial advice. For more investing videos, visit my website at 3minutebreakdowns.com. Thank you for watching.